Alrighty, good morning traders and welcome to Preachy Friday. Oh yeah, it's Preachy Friday and it's gonna happen today. I'm only kidding. Alright, so a couple of things have happened so far. We've had impeachment over, right? President Trump has been acquitted through the Senate. We've had the State of the Union, which was a success. We've had the job reports come out this morning. That wasn't a success. But let's take a look and see how the markets reacted to it. We had unemployment rate drop. Sorry, my bad. We had the unemployment rate increase. We had the average earnings drop. We did have good employment numbers. But overall, let's take a look and see how the market reacted. Now, hopefully everyone's got their cup of coffee. We've had a great week so far. We've closed out over 3,000 pips this week already. We've only got one trade, only one little itsy bitsy little trade left, and that is the the US dollar, Canadian dollar. So US dollar CAD is the only trade that we have open. We spoke about it yesterday, and we said that we don't care what the fundamental does this morning. All right, we don't care if the market goes ahead and rallies or dips. It doesn't matter to us because we have a plan. All right, and we know exactly how to be able to manage that position. So let's take a look and see what's going on right here in the market. And you can see that we did in fact have a rally. Despite of the bad news out in the US, we had the market rally in most part of today. So 24 hours, we've had a rally. Now, if I go to, and I'm hoping that I may need to go ahead and play around with my mic a little bit. Just give me 1 second. All right, that may be better. All right, so if we go ahead and take a look at the way the market moved this morning on the 1 hour time frame, here it is right here. You can see that even the 1 hour time frame really never got any movement out of the market, right? We didn't really get any movement at all. Now, keep in mind that we also had Canadian data out this morning, all right? We also had Canadian data out this morning. And if we take a look at the Canadian data, we can see that we actually had good numbers, both for the employment change and unemployment rate. The Canadians are really excited about that. Positive news. Now, if we're having positive news out of Canada and we're having negative news out of the US, what would you think that the directional bias would be? What do you think the market would do? You would think that the market would go ahead and I'm talking about the US dollar Canadian, you would think it'd go ahead and sell off, right? Because we've got strong Canadian, weak US dollar numbers, so you would expect the market to go ahead and move back down south. But traders, with the State of the Union and the impeachment all over and done, and ended up with a positive note, this may be what's discounting price right now, all right? This may be what may be offsetting the movement of the market right now, all right? Now, if we go ahead and take a look right here, and take a look at the details right here, notice that price is still showing zero movement, despite of what we anticipated, what we think should happen to the chart. Now, I'm going to go ahead. In fact, look here. We're even getting a little bit of further bullishness right here. Now, traders, I don't believe this is going to hold. All right, I really don't believe this is going to hold. I believe this may just be a fake out, which means traders are going to believe that, hey, listen here, price is moving up. So what? We're thinking bullishness, right? We're thinking bulls are taking control. Well, that's what the retail traders are going to be thinking, right? But as a trader that understands the movement of the market, we're now going to look at this and say, well, this is just a temporary rally. This is why I call it a little bit of a fake out, because we had a little bit of range-bound trading right here. This is a fake out to the upside just to get you my liquidation levels right here. All right, get you those liquidation levels. Turn around, head back down south. That's what we're looking for. Now, we are in on this trade. We are currently selling US dollar Canadian. You may be saying, well, big dog, sorry for you. You're in the wrong direction. All right, no. Because what we follow in this trading room, what we follow is a unique trading strategy that actually plays against the retail traders. When retail traders are buying, we're selling. When retail traders are selling, we're buying. So we're actually trading against retail traders. Because if you look at the trend, based on the chart, you would think that every single retail trader is thinking, let's follow the trend, right? But what we have to understand is that institutional banks, institutional traders, in fact, most of the major banks in the world, what they're doing is they're looking to manipulate price for them to get a better deal. So when they're pushing price up, all they're doing is getting people to buy into this this rally, only for them to go ahead and reverse it by adding in some positions very slowly. They do it very sneakily, right? Yeah, a sneaky Pete type thing. What they do is they start adding tranches in at a slow level, all right, to a point where at some point they're going to have a whole bunch of cash pushing price back down again. And so that's what they do. They go under the radar. They go into small tranches, so it's not big. They're not going to go with like a few million, a few billion. They're going to go into small tranches at a time to where they've got a big position in. And that's what we're doing as well. We're going ahead and we trade in with small bits of lot sizes so that we're building up a bigger lot size. So when the retail traders are all banked in on the buy, the institutional banks are going to be pushing price back down again. And that's what we go ahead and trade. All right. So with that being said, we're looking for price to go ahead and work its way back down. But we have to understand that this right here is just normal. This is normal. As price comes back up again here, we'll be looking for resistance. If it goes all the way up here to the trend line, that's okay. We'll be looking for price to go ahead and work its way back down. Now, this could be, we could have an immediate turnaround right about here, right? We could have an immediate turnaround right about here, okay? But if it goes up a little higher, we're okay with that, all right? Because we've got enough to be able to, we've got enough equity in to be able to continue to sell the market a little bit higher up here. All right. Now, Patricia says, looks like consolidation when they scale in continuously with their huge positions or huge portions. Yes, that is correct, Patricia. That is absolutely correct. Now, it may seem like consolidation, but it could also be a correction move, right? Because remember, traders, that price can move in waves, all right? And what I'm saying about that is something similar to this, right? Where as the market goes down, right, price is pushed up, and then price is then dipped down right here. So this is the wave structure right here. So when we see price pushing up right here, we know that at some point, banks are going to start moving the market back down south again. Now, it's just a matter of time when. Now, this is a daily time frame, and we can see the bigger picture overall. But a lot of retail traders don't get to understand, you know, when is it time to start selling? Because if you look over here, this trend line that I drew down here only was created once these two positions were held. Once we hit these two highs right here, then of course we started looking for price to go ahead and move down. But before that time, price was moving up, and retail traders don't know when to go ahead and reverse it. So what they're doing is they're adding on. They're going in, following this trend. But it's the timing that's important right here. When is it time to go ahead and look to reverse and head in the opposite direction? Well, that's where we come to the strategy we're currently trading. We have a fantastic strategy in place that we know and we understand exactly when the market's going to turn around, and it's based off these targets. These targets are pivotal points, and these targets are levels that the market will gravitate towards 97% of the time. And so that's the reason why we follow these targets. That's the reason why we trade towards these targets, because we know that price is going to balance itself off, offset itself, get to a neutral zone. And these targets that we follow are exactly what it is. Now, let's go ahead and take a look and see what's going on with the this pair right here. Let's go. Okay, so this is the trade we're in right here. All right, we're in at with the US dollar Canadian. We're in at 132.95, and we're currently at the moment right now chasing after a target of 132.09, but we are not done. We may end up getting additional positions in, and yeah, you can see right here. I call this a whiplash right here. All right, this is where price gets pushed down based on the news. Listen here, this movement right here is everything you would expect the market to do, right? This is everything you would expect the market to do based on the fact that we did have positive news out of the US, sorry, negative news out of the US, and we had positive news out of Canada. So that's the breakdown that we were expected. It did not sustain itself, but I don't believe we're done yet. All right, all right. And if price moves up higher, it's okay, right? We're going to be okay. Now let's go ahead and check out what we did this week. This is what we've done so far this week. We're up 3,016 pips for the week. We had a great month for the month of or at least month of January. We did okay. We made 1,056 pips in the month of January. February was a build up. You can see we closed out no positions last week. This week was a build up from last week to this week, giving us about 3,016 pip gain on that. That was awesome. And so we're actually pretty much going to start off fresh again for next week. Right, so we're starting fresh again for next week, and we only got the one position in over here, so that's good. This is where we're at regarding the positions. You can see that we had most of our positions this week. We had hit targets this week, and we had two trades that were taken on this week. One is paid off already with $62, and the other one is still active here with the US dollar Canadian. We're currently still selling. This is where a majority of our cash came in, right, from this right here. This was previous positions that we held, which is from last week. That's what really was our, that offered a good payday for us this week right here. So that was great. So keep that in mind. As you go ahead and take a look at the details right here, keep in mind that there's going to be times that we're going to carry over positions over the weekend. All right. If you've never done that, or if it scares the living crap out of you taking on positions over the weekend, I want to go say this. The way we trade, and I know we can get big gaps in the market because the Forex brokers close on a Friday, they reopen on Sunday, and because we have a 24-hour market that's constantly trading, price can move further down or further up by the time Sunday opens up, right? And so by the time the brokers close on Sunday, on Friday, to the time that the brokers reopen up on Sunday, there could absolutely be a price difference, which is called a gap, all right, the weekend gap. And if the market's going to gap over the weekend, then we have to realize that if we're in a position, then we could be deeper in the red or deeper in the money by the time the weekend ends and restarts again, right? Or they say the week starts, by the time the week starts. So the way we trade, all right, accommodates for those type of movements, all right? We do accommodate for those type of movements. And so what's important that I've mentioned constantly, week over week over week, what I've mentioned is it is important, traders, that we understand equity management, that we understand how to be able to manage our positions so that if we ever get to a scenario where price is gapping over the weekend, it doesn't affect our trading positions regarding equity. As well as these fundamental announcements that take place, non-farm payroll, impeachment, we've got Brexit news, we've got all of this other stuff. If we manage our positions correctly with regards to good equity management, we can go ahead and trade through this news and it won't affect you as much. In fact, it will be good for you, because when you have these big movements in the market, normally price gaps quite a bit. So if price is trading at a level and it gaps down because of a news event, those gaps will get filled again. Price will come back up to retest that. And when it does, we've already added on positions looking to trade back to those levels of the breakouts. And so again, we have to have good equity management to manage those positions. All right, so quick one. How did everyone do this week? We captured about 3,000 pips this week. How did everyone do this week? I'm busy watching the chat right now. I want to know from you, how did you do this week? And also, I want to also say this while you're going ahead and posting those details there. We have a live 2-hour class taking place next week. It's for everyone that owns this trading system, the target trading auto system. If you own the auto target trading system, which means you're one of my students that own the target trading auto trading system, then you have access to this live session that's going to take place next week, Wednesday. All right. It's going to be details are going to be sent to you. It's going to be inside the online on the online university. You'll be able to access the information. We're going to have a 2-hour session. What is the 2-hour session going to be about? It's going to be about equity management. Listen here. The auto trading system is doing everything for you. All right. It's going to trade for you. It's going to manage your positions for you. But you have to know how you need to set up the risk management side of it so that you don't get into an over leveraged position. All right, which means traders, we have to look at a whole bunch of things. We got to look at account sizes. You know, if you've got a large account size, if you've got a small account size, how many positions can you trade? How many currency pairs can you focus on? All right, that's important. Right? Sometimes it's not. Sometimes it's better to focus in on 1 or 2 currency pairs, and maybe add a little bit more risk on those 1 or 2 currency pairs because the fact your account size might be smaller. But if you go ahead and you want to go ahead and trade, let's say 28 currency pairs, you have to know what you're getting yourself into. You have to know the consequences if price moves against you and you have got multiple entry points in. You see, those are the type of things that traders don't quite understand. They don't understand that it costs money to get into a position. Well, it doesn't literally cost you in the sense of it's money you're losing. It's money that is in what we call a holding deposit, right? It's money that's going to be held for you to hold that position open, and that's called the leverage. So you have what you call margin requirement for each position, and that margin requirement is the leverage that we're using in order to be able to trade our position. And so if you're going to go ahead and enter, you have to know what your brokers are offering you with regards to margin. What are your margins? What are your leverages? What is it that your broker is charging you, or these holding for you to hold a position? You need to know that, because that comes off your total balance. So if you've got an account size of $10,000 and you enter a position, a standard lot position, which maybe you won't be entering that, but if you enter a standard lot position, let's say on the pound pairs, and it costs you $1,600. It doesn't matter what currency pair. Let's say it's $1,600. Well, it doesn't matter what currency pair it is. But let's say you enter a trade and it's costing you $1,600 to get into that position. That $1,600 comes off your balance of margin available. So which means your margin available now becomes $10,000 less the $1,600, which puts you down to $8,400. Now let's say you go into 3 positions. And 3 positions then going to go ahead and take you down to, let's say, for argument's sake, let's say $4,500. To hold 3 positions is going to cost you $4,500. So take $4,500 off your $10,000. Now you've only got available to trade $5,500. Now that's 1 currency pair. Now think about if you go ahead with another 2 currency pair and you have the equal amount of entry points, 3 entry points, and that's costing you $4,500 on each of those. You're already running out of equity. Let's say you only go in with 2 trades with 3 positions in, and it's costing you $4,500. That's $9,000 that's coming off your balance. That leaves you only with $1,000 left over which, by the way, holding 3 positions on 2 currencies, you may even be in a drawdown of $1,000, all right, because that is now over leveraging your trade. So we have to be conscious and aware of the fact that we not only have to be able to sustain the drawdowns on our trading, but we also have to understand that we're going to have less margin to be able to trade when we take on more positions. And because the strategy is very successful, all right, when you follow the rules, we have to know what the rules are. So what are the rules? Number one rule, make sure you understand what your margin requirements are at your broker. Number 2, make sure you understand what type of risk you're going to take on so that you can minimize the drawdown on your trading account. All right, so you give the market room to move, but also that you don't take too much margin out of your trading account to be able to hold those positions. Because if you have big margins, big drawdowns, margin call is what they call it, right? All right, that's a definite thing. So big margins, big drawdowns, margin call. Small margins, all right, small drawdowns, you ride the wave. And that's what we want to do. We want to be able to ride the wave, because if we can enter as many positions as we possibly can and still keep the drawdown small, all right, we'll be able to ride the wave, and we can have these type of returns that I'm going to show you right here. We can have these type of returns where you can make 68,000 pips for the year. You can make what's the other one right here? 68,000 for the weekly targets. 24,000 pips for the monthly targets. These are different targets. Now we're looking at the the weekly targets in this session. All right, we're looking at the weekly targets in this session. All right, and if we're looking at the weekly targets this session, then that means that this is what we could have potentially built out over the period of last year. We're looking at 68,000 pips. All right, 68,000 pips. Now, let's go ahead and take a look and see each of these positions. I'm just going to go to the euro position right here. If you take a look at the euro position right here, you can see that on the weekly targets last year, we took on 20 positions. All right, 20 positions last year. These are the 20 positions. We actually had one losing position right here. The rest were all positive, right? And traders, the reason why that was all positive is because we managed to have good equity management in place. Now, there are some trades that we did take some losers on, because we remember last year we had the flash crash, we had the trade wars, and that created a lot of volatility in the market, right? And with that amount of volatility, if we didn't apply the correct risk in the trade, we would have been margin called. And so these type of returns are fantastic. I mean, it's great. But the only way that we can sustain these type of returns and be profitable is if we manage our risk correctly. All right? So that's important right there. So just keep a note, next week, Wednesday, we're going to have a 2-hour session for those that are part of the target trading, auto target trading. All right, traders, going back to this week's trading. It's been an awesome week. It's a fantastic week. We don't have any more trades except for the US dollar CAD. All right, that's the only position we have right now. We will continue to hold that position over the weekend. We'll take a look next week and see exactly where we are next week and how we'll be able to handle that position. It's very possible that we're going to pick up new positions next week. All right, so next week, prepare yourself for new positions. The trading session, the Forex morning coffee will not take place on the Monday and on the Tuesday. I'm going to be in Las Vegas. In fact, I'm flying out this evening to Las Vegas for the weekend. And I will be back on Wednesday. So Wednesday will be our first session. All right, first session, and we'll go ahead and take a look and see how the markets are moving. Listen, you guys, have a fantastic weekend. All right, keep it real. Make sure that you are absolutely ready to rock and roll on Sunday at the open so we can check out those trades and start placing those trades. Also remember as well, every time you go ahead and put in a trade, always got to think about the downside. What is my risk and how am I going to manage it? And can I afford to trade that trade? This is the FX Big Dog, and I will see you next week. Next week Wednesday. All right, cheers.